I just really had one stream of income. And I thought, well, how the hell do you have 7 streams of income? That just didn't make sense to me.
Making money in your sleep is not a myth. Today's guest is proof of that. Travis Watts is a full-time investor and the director of investor education at Ashcroft Capital. The secret to how he's been able to travel whenever he wants and have complete control of his time and lifestyle is the same one the most affluent families in the country have been using to build and preserve wealth for generations. So how do the rich get richer? Keep listening to find out.
My initial years in real estate were about building up equity, right? And I needed a nest egg so that I could go become a passive investor. So when I really started honing in on passive investing, everybody's number is different. This is what I realized from years of working jobs early on, where sometimes I had a low salary that was, 25,000 a year. And then sometimes I had a high salary of over 6 figures. And what I realized is, first of all, very few people talk about or educate themselves on the benefits of passive income investing. Very few even understand what that term means, myself included. I used to think, having a single family home and managing it myself was passive income. It really wasn't. It was pretty active and hands-on. So I'll break it down to you this way. I got to the point, I was working in oil and gas. I was making 100 and whatever thousand per year, 98-hour work weeks, 14 hours a day. It was brutal. I was away from home all the time. I had no social life, no dating life. I just had no life outside of work. And I said, okay, if I sell off all these single family homes, some were vacation rentals, some were flips, some were buy and holds, and then one was the house I was living in with roommates. I said, what if I liquidated everything, paid the applicable taxes, and then I went into passive income investing? What is a yield that I could potentially conservatively achieve at that point? Now, this was, again, 2015 and 16. In the multifamily apartment space as a limited partner, it wasn't unheard of to get a 8, 9, 10% cash flow return in the first year. So I said, okay, let's go with the lower number, 8%. And I created what I call the 8% rule. And it's that I'm going to live off 8% on my portfolio that's coming in the form of, distributions, cash flow, dividends, whatever. And I'm not going to touch the principal. I'm not going to sell the golden goose, and I'm going to quit doing these speculative investment plays where I'm hoping on appreciation that may or may not be there. Much harder to predict that. So here's the math. Let's just say, for simple math, I had made 100,000 in oil and gas even. So if I had 1.25 million to invest at 8%, that effectively would give you 100,000 per year. It would potentially be even more tax advantage. And we're not even talking about any potential equity upside in these real estate deals, which has almost always been there historically speaking, where we do buy low and sell high. But the primary focus was on passive income. So that was kind of my starting point. I said, okay, basically, again, real high level numbers. You need like $1 million for every 100K that you want to achieve if you think you can achieve an 8% return. 4% return, just double the number. You need 2.5 million at 4% to get the same outcome. You think you can do a better return, maybe 10%. You only need a flat million instead of 1.25. So I started thinking in terms of that. And for me, the $100,000 salary was enough to afford everything that I needed and wanted in my lifestyle. And so I ended up making that transition and leaving the oil and gas industry.
Just to provide a little more context, how long did it take you to reach that point where you were financially free once you decided passive income was the ultimate vehicle you wanted to take to reach that lifestyle freedom you were aspiring to reach?
Yeah. So the first thing I'll say, I was a super motivated person with a lot of willpower and drive. I was single with no kids, no pets. So I had nothing but just me, myself, and I, right? So I just hit the ground running. I did 6.5 years of what I refer to as the dark years, years where I wasn't on social media. I wasn't doing any kind of advocate stuff. You didn't see me anywhere because I was grinding it out. I was just working and saving and working and saving and doing everything I could to build up a nest egg. So it was also during a time where I started my investing journey in 2009, which was not the bottom of the market, by the way. A lot of people say, oh, what perfect timing. Not really. The house I bought still kept going down after I bought it. But anyway, it was a cash flow play. So it ended up being an equity play later. So I did fix and flips, vacation rentals, buy and hold properties, and I worked a W-2 job, and I was as frugal as I could be. And I lived with roommates, and I did house hacking, and I just did everything I could to inevitably have, the million plus kind of opportunity to become a passive investor.
Yeah, I've heard you in the past discuss how you come from a single family investing background and you had some rentals and like you said, vacation rentals, things like that. And that's something similar for us. We wholesaled, we still do some flips on the side, and we're very much actively involved in our business as well as the multifamily, of course. But I wanted to know in the past, I saw a post you've made that you said the pursuit of passive investing in real estate, it isn't necessarily that you're chasing freedom. It's creating a life that you don't need freedom from. And I thought that was such a a great way to put it. Can you provide some insight into what kind of lifestyle your passive investments have really allowed you to live, just to create that almost visual imagery for people?
Yeah, I think you hit the nail on the head. So you could call it lifestyle design, you could call it lifestyle optimization, but here's what I think about. Instead of thinking about, oh, I'm starting with zero today and I need to get that 1.25 million in the bank, right? That's kind of overwhelming. And a lot of people give up just solely on the fact that I don't even know where to get started. That's going to take too long. So here's how I look at it. If everybody's got pain points, whether it's I hate mowing my yard or I'm stressed on a Friday after work or whatever, right? So you could just save up enough to make one passive income investment. And if that kicks back, let's say 200-300 bucks a month in passive income, you could start using that money today if it's not in these accounts to where you have to be 60 plus to touch them. And you could pay for 2 or 3 massages per month. You could pay for a landscaping company to mow the yard. You could pay for a house cleaning service to clean your house. Like whatever it is that is your pain point that you're trying to make better in terms of lifestyle. Maybe it's travel. You could take 2-3 extra trips per year and vacation a little bit more. So to me, I'm still very frugal on things that I don't really care about. So I'm going to save the most money in those categories, but I will well overspend on things that bring the most value to me. And some of those are expensive and some are not. So you kind of got to start with a list, would be a good way to do this. And it's just the top 10 things that bring happiness and fulfillment to your life. It could be charity, it could be something as little as I like eating chocolate or it could be I love, traveling to Europe or to Asia or something like that. But you need to double down on getting yourself closer to the things that you love and enjoy and look at ways to outsource your pain points and the things that you dislike. And I believe most people can get there a lot quicker than you think. And it's just disheartening sometimes to listen to people's stories of simple pain points they've had for decades on end that they've never addressed because they don't have the priorities in line.
Yeah, your perspective is so refreshing. A lot of my peers were recent college graduate age, and a lot of them are pushed into getting a job. And just it's not necessarily that it's a bad thing to get a job, but I'm saying there's this paradigm that you have to work X amount of years in order to create that lifestyle freedom, or if they even are ever exposed to the idea of lifestyle freedom to begin with. And in the past, we referred to the success cycle, and I resonated with that really heavily because in high school and even in college before I left to pursue real estate, it was something that was very much so in my mind of, oh, I have to do this steps in order to reach the life that I want. And I didn't even know real estate or investing was an option. And so I'd love to know, can you explain what that success cycle is? And before this interview, you've also mentioned the financial hierarchy of needs. If you want to
Yeah.
maybe connect those, I think that'd be a really awesome way to explain why passive income is such a powerful tool people can use to really create that lifestyle freedom.
Sure, man. I'll share a story with your listeners here about the success cycle. But as you were talking, this just reminded me yesterday, literally, I just had a nephew graduate from high school. So he's trying to figure out what to do with his life. Came across this post that says, the American dream is a debt trap. And it says $80,000 college, $30,000 wedding, $300,000 house, $40,000 car. We trap people in their 20s to spend the next 35 years uh, contributing their time towards a job to pay it all off. And I bring that up because I think that was a great post. But I shared with my nephew, I said, my journey began by starting to think differently and going against the grain of kind of what the masses do. So I shared my numbers with them, and I'm like, college was zero for me. I got a 2 year degree. I did it through a scholarship and being super frugal and working part time. My wedding was like $10,000, and we had a destination wedding in the Bahamas. It was beautiful, and we had a lot of people there. But took a lot of planning, a lot of hard work, a lot of phone calls, a lot of effort. But we made it happen. First house was $95,000, not 300 plus. And then my first car was like $5,000. And I don't think I ever spent more than that for like the first probably 7, 8 years of driving or something like that. So I stayed very minimalistic. So something to keep in mind. So you asked about the success cycle. So the success cycle, here's how the story goes. You've got this engineer. He graduates from college. He gets this job. He goes into a high salary W-2. He spends, 5, 10 years working with this company, making good income, safe, secure job, et cetera, et cetera. Well, he gets this bug that, hey, I want to branch out and do my own business. I'm so good at this. I think I could beat a lot of the competition, blah, blah, blah. So at this point, he's got about $1 million net worth through stock options and 401k and savings and all these things, right? So he launches his business with that first million. He puts it all into the business. He puts another 10 years into that. So at this point, we'll say, I don't know, he's 40 years old, and he sells that company years later, and he profits 2.5 million, maybe $3 million, something like that on the sales. Just a made up story, by the way. I'm just painting this visual for everybody. So 3 million plus at this point, decides I'm going to do a different business with a different angle, and I think I can do it bigger and better. So this time he puts 20 years into the business. He puts all his money in there, and he ends up selling that company for $10 million. And at this point, he's 60 years old. He's at retirement age, and he says, I'm good. I'm going to call it quits. I got all this money now. Well, if you take a few steps back and you think about it, when he was in his mid 30s to maybe mid 40s, did he have enough to retire at that point? What if he had a paid off home at that point? And what if he had his $2, $3 million invested at 8%, and he could make 300,000 for the rest of his life through his investments, not even talking about the equity upside, as we mentioned earlier. So I just think that's the success cycle. I want more. I want more. I need more. I need more. I need the vacation house. I need the boat. I need the RV. I need the third car. Do you really need those things? Why are you pursuing those things? There's nothing inherently wrong with any of those things if they truly bring value to you. If you're not doing it to impress other people or to keep up with the Joneses, or because you think that's what society demands on you, or because you're a doctor and all your doctor friends drive BMWs, so you think that's what I got to drive. You just have to think outside the box and think differently. And to me, there's no bigger asset, there's no bigger value in this world than your time. And it's something I call time freedom. And passive income allows you to buy back your time. And, you can always get more money. You can never get more time, except for through passive income potentially. So that's kind of
Yeah.
the underlying message I've put out there for the last several years.
Yeah, and something that came to mind while you were talking was I guess this misconception that my friends and I, so they're also real estate investors and entrepreneurs, and we all kind of fell for this misbelief that passive income is, I'm not going to say it's not as important as active income, but we undervalued the importance of active income and accumulating it before you really start even attempting to look at passive income. And for us, since you're trading your time for that active income, I would say it has a different kind of value. And so I would love to know, I know step one of really reaching your passive income goals is to generate that active income. And something we did was we didn't put in enough effort and focus on generating active income to invest passively. But can you explain why it's so important? Why is that step one?
Well, it is because for a lot of people, myself included, it's just not that exciting if you have $1,000 to invest and you go make 8% on your money. you know, you look at that monthly amount, it's not even enough to pay your cell phone bill. So it's just not enticing. A lot of people aren't going to continue the journey if they're at that stage. So the 4 steps that I took to financial independence was to focus first on your highest and best earning potential, which is exactly what you're talking about. It's active, income. For me, it was oil and gas, working a lot of hours as an employee and flipping houses on the side and doing vacation rentals and having roommates. To me, I was maxing myself out. But here's what you have to remember: it's for a period of time. This isn't something I say you should always do this until the day you die. You will literally die in like your 40s because you're going to be exhausted and not be able to handle the stress. So if you can manage to do it while you're younger and maybe while you're single and before you have a family and stuff like that, that's the most opportune time. As most people are frivolously throwing their money away and partying and living paycheck to paycheck and blah, blah, blah. If you can hustle and grind in your 20s, it's the best outcome you can have in your financial life, in my opinion. So that was step one: highest and best earning potential. Number two, live on as little of that income as possible. Again, for a period of time. I'm not one of these, I don't know, Susie Ormans, cut up your credit cards and never spend any money and live below your means till the day you die. That's not what I advocate. It's just do this until you start to reach the financial independence goal that you're trying to reach. For me, that was 6.5 years. For someone else, it might be 5 years, 10 years. Everyone's going to be different. Depends on how much you want to hustle and grind and what it is you're doing for income. So that's number two: live on as little as possible. Number three, you have to become an investor. You can be an active investor. You can be a passive investor. You could buy stocks. You could buy real estate. You could do oil and gas, ATM machines, car washes. There's a million things you can invest in, but don't just put your money under the mattress. Don't just put your money in the bank, even if they're enticing you with a 3% yield or something. It's just not going to get you to your ultimate goals in most cases. So 3, have to become an investor. 4 is avoid bad debt. I define bad debt as the interest rate being higher than what you could otherwise achieve if you were to invest. So that's going to be a different definition for each person. So if I think as a passive income investor, I could reasonably make an 8% annualized return, and I have credit card debt at 20%, I need to pay off the bad debt. That should be number one focus before I start doing these 8% investments. It just doesn't make financial sense, right? But if I've got low interest on a car loan or student loan debts at 3%, and I could otherwise make 8 by investing, I personally would probably pursue the investing over paying off the debt. So a little bit different take on it than what you might hear from some other people, but that's how I view it. And those are my 4 steps to what inevitably led to financial independence in my own life.
I think investing, that's a very critical step. I want to expand on that because a lot of people, particularly, early on in their investment journey, they will see certain investments as, I guess, obviously more risk, more potential for reward. But in the past, you've created a distinction. You've done a distinction between speculation and investing. And I would love it if you could maybe clarify what the difference is, because some people would say investing in a cryptocurrency is just as good as investing in real estate, or even potentially better if they can see a higher return. So can you just
Yeah.
maybe clarify what is that difference? Like, what is your perspective on that?
Yeah. Well, the thing that I like specifically about real estate and passive income or cash flow is it's much more predictable than guessing what that real estate is going to be worth in several years from today. As we just found out from 2022, the Fed raised the Fed funds rate, at the most aggressive, fastest pace they've ever done on record. So you cannot predict those things as much as people like to pretend they have a crystal ball and pretend to know that Apple stock's going to go to this price and Microsoft's going to fall next year and blah, blah, blah. Most people are wrong. And even if you get it right once, you'll probably get it wrong the next time. And that's always been my experience with speculating, especially in stocks. And what I didn't even realize that I was speculating in the beginning years. When I was flipping properties, I just assumed that the market would stay flat or go up. And therefore, if I could just, get a few different things done and improved, I would make money. But markets shift, markets change. And as I started building more wealth, I got very paranoid about that. We were out in the Denver, Colorado market, and that's where all my properties were, is down the Front Range of Colorado. And I'm like, man, I'm taking an awful lot of risk by not diversifying here. And I'm speculating that the market's just going to keep booming and booming, and people are going to keep moving here, and taxes are going to stay low, and insurance is going to stay low, and we're not going to have a natural disaster. And I just got very, very, very uncomfortable having all my eggs essentially in one basket. Even though they weren't in one deal, they were in one market, in one asset type, one location. So that prompted me to want to diversify a lot further out. Speculating from a general sense is this: you're guessing what's going to happen in the future in terms of a price, whether it's real estate, whether it's stocks, whether it's anything. You're guessing on something. Um, Cash flow investing is like, I'm going to buy a property today. It's 30 years old, and there's a 30-year track record of it producing passive income on a monthly basis from residents. It's been through natural disasters, it's been through turmoil, it's been through political changes, it's been through 2008, 2009. I mean, it survived through all of this stuff, and I have proof of concept. You could look at the same thing in the stock world. If you're investing in a stock for its dividends, you can go back, if it's an old enough stock, and see these guys have paid a dividend for like 30 years plus every single quarter. That gives you a little more certainty than saying, what's the share price of that stock going to do next year? Or what if the stock market goes into recession next year, right? No one has those answers. So quit speculating. And especially if you've got larger amounts of capital, and become an investor.
Yeah, and so for the people that do get into real estate and they're, gun ho about jumping into the real estate industry, sometimes they will hold on to a property long term. They'll buy a single family house and just hold it, aiming to make their money on appreciation. And I know in the past, especially early on, I think you had a townhome in 2009 and you bought it for around 95K, and you chose to sell it. And I think there was two distinct lessons you learned from that. So if you want to share, what did you learn about the velocity of money and compound interest when it came to that? And why did you choose to sell it where a lot of people might frown upon that because you're selling an asset, right? Instead of holding it and keeping wealth.
Yeah, so I did a short podcast on this first on my show. It's called Passive Investor Tips under Joe Fairless's Best Ever Real Estate Investing Advice podcast. And it's called The Velocity of Capital. And I also did a presentation in March in Salt Lake City at the Best Ever Conference on this. But here's the bottom line. To your point, I had this property. I bought it as a value add fixer upper in 2009 at a depressed price. And I started thinking about this recently. It's been about 15 years. And I thought, what if I had added value to that property, rented it out, and kept it through today and then sold it? What would my gains have been? And when I first ran that analysis, I mean, the property's valued around $250,000 today. I bought it for $95,000 back then. So you look at that on the surface and you say, wow, that would have been an amazing deal. I should have just held it, right? That would have pocketed me $200,000 plus, plus any applicable rent. Well, what I did instead is I moved into the house as an owner occupant. I fixed it up while I lived there. I fixed it up cheaply. I rented one of the bedrooms out fully furnished to a college student because it was about 2 miles from Colorado State University. And I was able to get pretty good rent from that. Then I made it a full-time rental property, and then I later sold it. And all that happened in about 2.5, 3-year time frame. So I only ended up making, X amount on the sale. It was nowhere near the, 200,000 plus. It was more like, 30 some thousand or something like that. But what I did is I rolled it into another value add real estate opportunity. And I essentially did a similar business model. I would buy, do a value add business plan, hold it for 1 year or longer, and sell it. And then I rolled that capital and my original investment into another property. And I did the same thing again, value add, rinse and repeat over and over. This is the velocity of capital. So I fast forwarded with just that segment of my portfolio. That isn't the only strategy I use as an investor. That's just the velocity of capital, which is a big one that I do. And I looked at the same 15-year time frame and what happened in my reality. And it was in the ballpark of nearly $2 million, starting with $20,000 as my down payment on that very first property. So the difference between the 200,000 in gains and the 2 million in gains was to keep that capital turning over and turning over and turning over. And frankly, I could have done better. I could have done better deals. I could have spent more time in underwriting on a few deals that weren't that great. I could have done 1031 exchanges and been deferring taxes the whole time. There's so many things I could have done to make that bigger. But the point is, the simple point is, that's a strategy I've used now for, 14, 15 years. It's one of my favorite strategies. It results in tax advantages, monthly cash flow, equity upside potential, and it's always keeping things fresh and new, keeps me on my feet, always going into new projects. So something to think about if you're of the mindset that I'll just buy a piece of property today and I'll let my tenants pay it off over a 30-year time frame, and my mortgage will be paid off, and then I'll just sit on it for retirement cash flow. Nothing wrong with that. Just know that you might be able to potentially do a lot more if you were to just fix it up, sell it, and move on, which is my favorite business strategy.
Yeah, absolutely. And that connects to some of the topics and points you were making earlier about it's not as exciting to have like a small amount of money, but a lot of times it takes a lot of discipline when you sell that property and not use that money on other things. And you're really just choosing to invest it into something else. So let's say you didn't necessarily break the bank with that first one, but you were able to grow it. And I know in the past you've discussed how important it is to be disciplined with that money. Instead of choosing to buy a car or a liability, you're investing it in assets and growing it. How long did it take you to reach that first milestone of quote unquote making your first million in real estate? If you can maybe calculate it or if you can remember. And also, why is self discipline so important? And is that the main trait you think that makes a millionaire in real estate?
Well, I think there's a lot of things. I think discipline, I think willpower, I think focus, I think ambition. I mean, you don't have to be an expert in all these things. I'm not trying to say, if you don't have all these as a personality trait, you're not going to make it. It's not like that. It's just that, yeah. And another thing is goal setting and knowing what your mission is. And I think that's probably the biggest thing. I remember when I was flipping homes and working in oil and gas, I had a buddy of mine that worked with me in oil and gas. And he's like, man, you got to be my mentor. You got to show me how to do this real estate stuff. And I'm like, all right, So I was a free mentor for him. I explained how I did it and how I underwrote deals. Well, he ended up doing at least two flips. And the first one, still cracks me up to tell a story. The first one he does, he probably made $60,000 or something like that, right? Well, he ended up buying a truck. So, he had no plan moving forward. It was like, okay, I got a windfall of money. What do I do? Well, he didn't have a system in place. He wasn't an investor by mindset. He didn't have long term objectives. So he just knew, hey, it'd be fun to have a cool truck and drive it around the oil field. So he completely squandered it. So the second flip, I was still kind of mentoring him at this point. He probably made 75,000, maybe 100,000, somewhere in that ballpark. It was a really nice, solid return for him. He ends up quitting his job and living on all of those distributions until they ran out. And then he went looking for work again to find another job. So, you fast forward 4 or 5 years later, the guy's back to square one, day one, no better off than he was before. In fact, in many ways, probably worse off. It took me, 5, 6 years of constant hustle. I had a lot of different income streams going. I didn't get real serious about net worth calculations and stuff until I made a decision to start selling all my properties off. And I wanted to make sure I knew what I was doing according to the numbers. I wanted to see what that net result was. But I've never been one to look at just net worth and be like, oh, that's my goal. I want to have, 25 million net worth. That's where I need to be. That's never been my goal. It's to have enough passive income to live a comfortable lifestyle that makes me happy and content, where I can fulfill the things I want to do and give back in the ways I want to give back. And from there, if you structure it properly, your income should just keep increasing, because you're going to reach a threshold where if you only need 80,000 to live on, but you're making 120, you just keep rolling over the excess into more and more investments. So if you look at a compounding chart, even though you're sucking up a lot of that, and again, we're not talking about equity upside in the deals and stuff like that. There is a way to kind of hit that infinite curve. In fact, if any of your listeners want this, I've got this spreadsheet. It's a financial independence calculator. You can plug in the amount you have invested, your return yield, the inflation that you predict, and how much you can withdraw each month. And it'll show you a curve that will either show you a ascending a curve, meaning, an infinite amount of money. You could live on X amount per month and your income will always just keep going up in theory, of course. Or it'll be a descending curve and it'll say you will run out of money by age 85 if that's what your situation is. So just, direct message me or whatever, and I'm happy to give that to any of your listeners. But that's actually been a critical tool for planning on how much is enough for my wife and I. And we still play around with that chart on a monthly basis just to look at different scenarios and be like, what if we only withdrew this much, for 5 years, and then we expanded it to this much, and there's a lot of cool stuff if you want to geek out like I do.
Yeah, is balancing that frugality with having an abundance mindset when it comes to money, is that something you've struggled with? I mean, because personally, that's something absolutely, like, we
It
struggled
it
with a
it
lot.
actually is, Kerwin, because I was raised by two parents. They split when I was 5 years old, and they were both independently frugal. The problem is, only my dad ended up becoming an investor in later years. He got into real estate and other things, but most of his life he never was an investor. And my mom's really never been an investor. And so I learned a lot about self discipline when it came to personal finance, which was awesome as a kid. And it allowed me to not blow money right out of the gate. But what I realized is you can only go so far with frugality. You make 10,000 a month, let's say. Well, you got to pay what, 3,000 in taxes, couple thousand in living expenses, couple thousand in food and insurance and cars and blah blah blah. You can only save a couple thousand a month on if you're really good at being frugal. So if you flip that around and look at the other side of the coin, which is income, it is unlimited. You could launch a business, you could become an investor. I mean, there's people that make millions and millions and millions of dollars every single month in passive income. So the sky is the limit. And that's what shifted my gears early on to focus more on the income and less on the frugality, because I started wasting a lot of time trying to be frugal, trying to spend an extra 30 minutes at the grocery store, finding the best deals and looking for the sale items. And, time is money, maybe I saved $10, but I just wasted 30 minutes. And what's my time value? If that's true, I'm valuing my time at 20 bucks an hour, which may have been the case when I was in high school, but that hasn't been the case in a long time. So, you start to kind of look at that as a metric as you get older and hopefully have more net worth and income.
Yeah, no, I can completely relate. My brothers and I, we were raised in a low income household, so we've always struggled with like being frugal, living below our means. It's something we're good at, but it's also it's been a shift to have an abundance mindset when it comes to money. So that's so important. I'm glad you really expanded on that. And the story about your friend who purchased that truck is definitely something that I connected that to the story of the Rockefellers and the Vanderbilts, and how the Rockefellers were had financial discipline and the Vanderbilts didn't, and so as a result, the Vanderbilts lost their wealth over the course of a few generations. And that two things I really wanted to like expand on there was, first, you mentioned your friend didn't invest in assets; he invested in liabilities. But another factor I think that I would love to dive into, but I think is just as important, is the ability to mitigate risk. And I know that you're a big advocate on diversification and not just different asset classes, but different sponsors, different types of real estate, things like that. And you also have been very vocal on the importance of having multiple streams of income. And I think that's something that like most people don't even think about. They think I have my active income from my job, and they're lucky if they have a really good 401k. So starting off, can you just explain, like, why is it that the average millionaire has 7 streams of income, and why is the 401k just relying on that as a maybe even a supplemental source of income isn't enough?
Yeah, well, I'm glad that you brought up that metric. I was actually going to bring up a similar stat. So, depending on what you read, and you'll hear 7 streams of income, nine, 4, 5, just the word multiple streams of income. It's so important. And that was an eye opener for me years ago when I just really had one stream of income. And I thought, well, how the hell do you have 7 streams of income? That just didn't make sense to me. But, today I've got like, 60 plus streams of income. And I don't plan on, reeling that back in or slowing that down. I hope to have hundreds of streams of income. But, there is a balance between not wanting to put too little amount of capital into each investment where it becomes this accounting nightmare and you can't keep up with what investments you have and all this crap. Um, I made that mistake years ago too. In syndications, I would only put like 25,000 into a deal. And then I'd have all these K1s and these extra CPA fees. And I'm like, oh man, I should have just done 50 or 100 or something. It's so important, man. And I've started to diversify more and more as I continue learning and growing and reading different types of books and listening to different types of speakers. So it started with just single family houses. And then I got into townhomes and condos and single family. And then I got into multifamily, then I got into self-storage, then I got into ATM machines, then I got into note lending, then I got into car washes. And I mean, the list goes on and on. There's so much stuff. I do publicly traded REITs, I do covered calls, I do ETFs. There's so much out there. And so you just got to broaden your perspective on that. But I promise you this, every year, there is a sector in my portfolio, or a deal, I should say, not necessarily a sector, a deal that gets hit every single year for one reason or another: natural disaster, a bad operator, interest rate rises, whatever. So that's the importance is, a job to me, if that's all you have is one income, whether you're self-employed or an employee, you could get laid off. You could have to take, they could cut your salary or something like that. You could get fired. The company could go bust, whatever. To me, that's the riskiest situation to be in. You have all your eggs in one basket and you're just praying that nothing happens here or else. And a lot of people end up losing their homes, losing their cars, having to downsize and move, and their credit gets hit. And it's a terrible, terrible thing. So just have as many as reasonably possible is the best advice I can give. And all it does for me, Kerwin, is it just creates a backstop. I still work actively doing things I love and enjoy, but I don't have to have the job or the consulting gig or whatever it is. I don't have to do it. I'm not doing it because I need the money. I do it for another form of diversification. And as long as I love it and enjoy it, why not do it? I still want to be an active contributor to society. I still want to help people, even though I could afford to just sit on the couch all day and rot away like, I'm 90 years old. I don't want to do that. I still have a lot of life left. So I think that's the beauty is, financial freedom and time freedom is not about retiring. It's not about, okay, I'm no longer going to have a job ever in my life and I'm going to go sit on the beach and travel the world. That's very few people's realistic outcome. For me, it's just a work optional lifestyle. If you want to get busy and do a project and work on it and get paid for it, great. And if you want to at any point say quits and you don't want to do it anymore, great. And then you can make a pivot and you could go do a charity for a couple months. And then, okay, that mission's over, transition and go do something over here now. And that's just always been kind of my perspective on it is I don't want to quit working per se. I just don't want to have to rely on one stream of income in my life. So I think it's hugely important to answer your question. And you also said, why is a 401k not enough? Well, again, as we alluded to earlier, one, you have to wait till you're, 60 years old plus. If you happen to still be working, you still may not have options at that point. It depends on the employee plan, And with a 401k, just so everybody is aware, there's a couple things I don't like. And number one's the taxes. If it's a traditional 401k and not a Roth, you're paying basically ordinary income rates, even though you're an investor having held investments longer than 1 year in most cases. And so you're giving up this potential 0, 15, or 20% tax rate for upwards of 37%, plus any applicable state tax on top of that. So that sounds terrible. You have pretty much no control. You're just handing it over to Wall Street and saying, hopefully the world does great. I have no control over it. You have very few investment options. I know when I've been offered a 401k, it's been like maybe 10, 15 different options. There's literally hundreds of thousands of options in a brokerage account, and you're limited to 10 or 15 inside of a 401k. And also you're capped out on contributions. What if you have a great year and you make a few hundred K? You may not be able to put more than like whatever it is, 20 some thousand into a 401k. So it may not get you to where you want to go anyway. So for all those reasons, there's a great book called 401 Chaos by Andy Tanner. I read that years ago and it completely changed my mind on the whole system, including 401ks and IRAs and the whole deal, with the exception of a Roth. I still like Roths. I still have a Roth, but everything else I got rid of. I'm not giving anybody financial advice. I'm not saying you should do that. I did that because I didn't have large amounts of capital in them and I paid the taxes and the penalties and I just got out of them and I went into real estate cash flow that I could use today to retire on.
One trait that I think maybe you haven't directly addressed, but it's really evident in your ability to just like weather the storms that you've encountered. You said at least one section of your portfolio is impacted negatively every year, is resilience. And I think for investors like you, that's really important, or investors in general. And as you mentioned also earlier, the Fed has been increasing interest rates and there's a market shift happening, particularly in the multifamily space. I would love to know, how has that market shift impacted investors like you, but also is there something that you were doing before that isn't necessarily working now, or that you've had to pivot or kind of adjust in order to maximize opportunities and limit the amount of risk you're exposed to?
Yeah, since we spoke last on the podcast, whenever that was, 2020 or 2021, a lot's changed in the market, specifically 2022. The stock market crashed, the interest rates went up fast. Now we're seeing the repercussions in commercial real estate, which is a big part of my portfolio, no matter what specific asset class we're talking about. So here's my macro level on it. I'm a dollar cost average investor, the same as someone would be in the stock market if you were just buying an index fund like the S&P for your whole life. There's going to be times where the market's overvalued and you're going to be overpaying. And there's times where there's going to be a correction or a crash, but you're going to be buying at a discount. And so you just have to stay long-term focused and not try to time the market. I'm sure everyone's heard the saying, time in the market is more important than timing the market. I can't tell you the endless stories from investors and myself, quite frankly, in the past, where I've tried to time the market. I've listened to these gurus say, the sky is falling, it's going to happen this April, just wait, and then April rolls around, nothing happens. And it's, well, no, it'll happen by July. Trust me, it's going to happen. And then July rolls around, and nothing happens. And, all of a sudden you look back and you miss 2 or 3 years of solid growth in the market. And so, yes, the deals I invested in 2020 and 2021 in commercial real estate were probably overvalued in a bit in a bubble of sorts. But today, the deals I'm investing in, we're getting at a 20 to 29% discount. The last three deals I've invested in, anyway. So you got to average it out. And so that's kind of how I come to terms with it. You have to expect losses are going to happen. You have to expect underperformance is going to happen. And just happened the other day in one of my public stock holdings. I have a high dividend stock I went pretty heavily in, and it had maintained the same price range for almost a decade, but it pays a double digit cash flow yield. And it just fell 40% the other day, just on a whim. I won't disclose, what company and what stock, but it's so disheartening. But here's the thing, if you think about it, if it paid me, let's just say it paid 10% a year, which is lower than it actually pays. Well, a 40% loss means if I had held it 4 years, I didn't actually have a loss, right? It just tanked 40%, but I've made 40% by holding it. So now I just keep holding it. And what are the odds that, it just keeps going down and down into zero? It can happen, but it's unlikely. Most stock market corrections are like 30 to maybe 40%. It's a pretty bad recession. So anyway, I'm getting off track with it, but that's my macro level on it.
Yeah, that's a lot. There's a lot of wisdom there, man. I know a lot of people. I can totally relate to the way you're saying. A lot of the gurus will say, "Oh, these a lot of opportunities coming in Q3 and Q4 of this year." Now they're saying, "Oh, it's going to be Q1, Q2 next year," and it just keeps changing. And so they're always, like you said, saying the sky's falling. And I think we were always looking for opportunities. We're not necessarily always investing, but we're always looking. Is what my sentiment is.
I made a whole report in 2020 during the summer. I started pulling all this data and all these headlines about the massive amount of foreclosures are coming. You just wait for this wave of foreclosures. All you real estate investors get lined up because we're going to get 50% off all the housing nationwide. Did it happen? I mean, there's just political stuff you can't control. There's stimulus stuff you can't control. There's supply, demand. We're undersupplied in housing. There's so much that goes into it. So I don't pretend at all to understand, all the ins and outs to everything. I don't have a crystal ball, but I just know I'm going to keep investing and keep investing and keep investing. And over time, it's going to average out. So on Instagram and on Facebook, you can search for passive investor tips and just DM me and I can point you in the right direction to whatever you need. You want to have a phone call? My link is there. You can look me up, Travis Watts, WATTS on LinkedIn, Bigger Pockets or ashcroftcapital.com. And always happy to have a phone call. Always happy to give you any resources, including that spreadsheet I talked about earlier. So reach out, man. I'd be happy to help anybody I can.